Jerry, thank you. I wish Mark was here so I could pick with him a little bit. I was on his podcast, or no, he was on my podcast. He pitched me. He's like, "Hey man, come to the meetup." Then he ghosted me. So I know how that is. It's all good though. So grateful for the folks that came out this evening. We're gonna have a little bit of fun. So it sounded like everybody's already in the deal, but I just want to confirm. So if you've never done a multifamily deal, will you drop a one in the chat? I know one person said they just bought one at like the beach and now they're moving to South Carolina. So there's at least one person who hasn't done a multifamily deal. But is there anybody else that hasn't done a multifamily deal? Anybody? All right. Is there anybody who's only done one multifamily deal? If you've only done one deal, give me a two. All right. And then if you've got multiple deals, let's call it five deals or more, give me a three in the chat. I think the chat's broken, Jerry. Like nobody's writing anything in here. Susie is in here. Thank you, Susie. You're so great. I'm glad you're here. I need you. You're gonna bail me out of this thing. Tiffany's at 2.5. I don't even know what 2.5 means, but Tiffany is complicated, so things will happen there. Okay, so with that said, let's dive into this thing, man. I put together slides. I've never actually done this before, so it's going to be really interesting to see how this goes. And I am going to dive in. Look at my mom and dad. They're up here rocking and rolling. So, look, we're going to talk about the myths of multifamily. I think a lot of you may already know a lot of this because of your experience in the game, but it'll be good for debate purposes, right? My goal here is to have a conversation about a lot of the things that are offered. So, if you think I'm completely wrong, please come off mute and let's argue about it. There's nothing like good banter, and honestly, I really enjoy those types of conversations because I've watched a lot of people try to do deals and not get them done. And then they get discouraged, they turn around, they quit, and they give up on this thing that could actually provide financial freedom for them. So I'm gonna roll into my background following this slide. Then we'll talk about the challenges. I think there are four main challenges that happen when you're trying to get into the multifamily space. So I'll run through those really quickly, and then we'll jump into the 10 myths that I've identified as worthy of talking about this evening. There may be more, but I picked 10 of the ones that I think come up the most and probably are the biggest impediments for most people. Then we'll wrap it up. And so this is not investment advice. This is not something you should talk to your CPA about, or everything that you do, you should talk to a CPA or a lawyer. And I say that with everything by putting a bow on it and saying, I don't know anything about anything. So if you go do something based on what you heard tonight, it's not my fault because I'm telling you on this recorded line that I don't know what I'm talking about. All right, so let's dive in, man. So back in the day, I was in my own little world. I built this $20 million division for a Fortune 550 company. I went from 2 employees to 175 employees. And by the end of the year, we made about $6 million in profit. My reward for that was laying about half those folks off. And I went through another year after blaming the company for making me do the thing. And then I realized I was going to have to do the same thing again. I decided that I was going to drop out of corporate America. So I exited the matrix. But while I was there, I was lending money privately and learning about rehabbing. When I got out of corporate America, I started self education. I had this dream on the shelf that I would go off and be an apartment investor. And in being an apartment investor, I'd get my financial freedom and I would have, this multi-million dollar real estate portfolio, even though I really didn't need one that big because my ambition when I was in college was to make $70,000 a year passive. And if I could do that, then I would be free and I would never have to trade my time for money again. The issue with that is I didn't know anybody who was in the space. And when I left corporate America, I was still in the same spot. I wasn't very deliberate in my networking. So I found out the hard way that experienced partners were necessary in order to get into the space. I found that out by going to 10 different banks and getting turned away over and over and over again. They told me that I didn't have the requisite experience. And so I went a little bit harder on self education. So I went through YouTube University and watched every video I could find on multifamily investing. And after I gave up on getting a loan for this 23 unit apartment building that I wanted to own, I decided to start fixing and flipping. So I went through that, did that for a while, and then I eventually got invited to be a partner on my first multifamily deal, which was the same deal that I thought I was going to buy when I first dropped out of corporate America. Ended up being an asset manager on that project. And from there, we went and did multiple deals. And about two, maybe three deals in, we were having some success. My friend, Dr. James Bryant, said, "Hey, man, we're using the Myers methods to buy these deals." I was like, "What's the Myers methods?" He said, "Well, you find, fund, fix, and then you flip them. And that allows you to create a extreme amount of equity, and you can use that to buy a bigger deal." And he started running through all these different scenarios, and he was thinking so much bigger than me at the time. And I was like, "Well, why is it Myers methods?" He's like, "Because you are executing the program, so you deserve credit." And so I didn't name it, but I felt really good about what happened. And so eventually we broke $1 million in capital invested from the risk side. And we did multiple repositions. And I was like, okay, now what? And so in COVID, or right before COVID started, we started looking at development. And so we rezoned about 6 acres here in Greensboro. We're still working through the process of getting those things built. What happened while the construction shortage was happening and supply chain shortages were happening, prices jumped pretty dramatically. And while rents have rose in Greensboro, they haven't rose enough to justify the construction costs that we're seeing. So we're trying to figure out how to overcome that. And part of it is just waiting to see if rents catch up or costs come down. So that is kind of my track record or history in the multifamily investing business. So now if I move into the challenges of getting into multifamily, what I found is there are four things that every investor's working to overcome. Doesn't matter how many deals they've done. And if you want to overcome those challenges as quickly as possible, then I think you should do them in this order. The first one is knowledge, right? A lot of us think, oh, well, it's just a piece of real estate. I'm going to go buy it, right? It's like going to Home Depot and picking up a hammer. And now I got a hammer so that I can hammer a nail with no training. And who knows, if you miss the nail, you hit the wall, you put a hole in the wall. Now you got to go get drywall. And it just becomes this self-fulfilling mess. And I think that's what happens with most people who get into real estate. They don't actually get the proper education, and what's supposed to be an asset ends up being a liability because they didn't buy something at the right cost basis with a great business plan, with an operator who could actually help them get it across the finish line. And they end up turning what was supposed to be a blessing into a burden. After you get the requisite knowledge, you need to apply that knowledge against leads so that you can make sure you have a deal, right? Leads and deals have the same letters, but they aren't the same thing. And with the lead, it is something that if you buy, it's highly likely you won't make any money. Whereas deals, once you vet them, you have a really high chance of making some dollars. And this for me is really important. I think we're at a point where cap rates are probably where they're going to be. And so the the gift of cap rate compression is not going to exist for people who are buying deals at too high of a cost basis. So I think we really, really have to be careful where we are in the market. Now, I've been saying that for a while, and cap rates continue to compress, but at some point, it will be musical chairs, and somebody will not have a place to sit, or they'll have a deal that they can't refi because the cap rate won't cooperate or their NOI isn't where they needed to be in order for them to be able to do the things they need to do. Once you find a actual deal, you need to connect with somebody who's an experienced operator. If you go back to my track record, you'll see that I got turned away from the banks because I didn't have experience and I didn't know anybody with experience. And so the next step in the process is making sure that you have people in your network who have experience doing a deal of similar size to the deal that you want to do. If you have that and you have a great deal, then you'll be able to get the big check, right? Usually, if you're putting debt on a deal, they're writing a check somewhere between 60 and 80% of the purchase price. And what I found is there's a whole lot of hoopla about the 20 to 40% that gets raised, but not much discussion about how you actually get a lender to provide the most money that goes into the deal out of everybody. And I think the bank or the debt partner is a actual partner in the deal, contrary to what most people would say. They're not just a service provider, but they end up being a partner. And if anybody's had a bridge loan and they've seen what happens when their money goes in a lockbox, it becomes really, really, really clear that they are a partner in the deal. And if they aren't heard, you can get in trouble pretty quickly. So, knowledge, deal flow, experience, and capital. Do you do some of those things in parallel? Yes, you do. But if you have capital and you don't have experience, you don't need experience, right? Like if a person doesn't have an experienced operator, they're never going to get the bank to lend money. If there is no deal, and this was one of the things that happened to me, I didn't have the contract on the deal. And so I was asking somebody else to include me in the deal. And it felt like I was asking for a favor instead of me having a contract and taking it to them and saying, hey, I've got this thing. It makes me valuable. Do you want to partner with me on the deal that I found? The quickest way to become really valuable to other people in this space is by having a contract, having a deal, and then inviting them to participate in the deal. So if you don't learn anything else tonight, take that one. Boom. Myth number one. And this is one of my favorite ones because I see people touting it, especially real estate or educators. I can do a deal with no money, no experience, no credibility. I just don't know how you're going to buy a multi-$100,000, multi-million-dollar asset there. And it's like, oh, it's a team and blah, 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 blah. I don't know anybody that's successfully done this. And I encourage people to argue with me about that because I haven't seen it. And I've scoured the internet to look for people who've actually been successful with none of the above. And so there is this thing called hustle, but what usually happens with the hustle is they get the deal and then they end up selling it more as a wholesale type of transaction than actually be included in the deal. So if you don't actually have the knowledge to evaluate the property that you're looking at, you're not going to get that far because you won't be able to provide the opportunity in a way that an experienced operator will take it seriously. Myth number two, you have a 95% chance of doing this with partners. I think it's the exact opposite. You have a 95% chance of doing this without partners. The vast majority of businesses, like over 95% of them, are sole proprietors. And I think a lot of us use the thought of having a partner as an excuse on why we aren't making the progress we want to make. Now, I did mention that you need experienced partners, but that doesn't mean that they need to be in your company, right? You can set up a holding entity or a single purpose entity to take down the property. You can bring your company in, you can bring another company in, and you guys can do the deal. And I think that's the way you should do your first deal when you're partnering with somebody. It always concerns me when somebody ropes in or loops in their whole business and puts it in a partnership with somebody who they've never actually done business with. You meet at a meetup or you meet at a conference and you're like, oh, we're buddies. We're going to get married. And what I consider to be a one night stand. So remember that a lot of this is going to happen and a lot of it's going to be on your own. And your success is really going to be tied to your own effort. So I grew up the son of a soldier and a stay at home mom. And we didn't have people that had multi-million-dollar real estate portfolios coming over to the cookout. The reality for me was the most people that I spent time with are first generation wealth creators. They were the first people in their families to go to college. And so that rich uncle or the aunt just didn't exist for most of the people. Today, my network looks very different. But when I got started, I can't say that I knew maybe more than one or two people who were millionaires. And the majority of those two people, I'm pretty sure that included the equity in their home. So the thought of knowing a ton of accredited investors was something that was distant for me, foreign for me. Today, I think almost everybody that I spend time with on a weekly basis is of high net worth or affluent. But I could tell you that I didn't start that way, and it was only through intentional connections and relationship cultivation that I changed my network. And so you're not trapped because you have a network, you have the network that you have. You can go out through meetups, social media, conferences, podcasts. I can continue to go down the list and completely change your network. And that is going to make a huge difference on the back end for you. Number four, and this one's one of my favorites, right? When people are getting introduced and they lead with their, here's Jerome Myers. He's got 6,000 units in multifamily assets. I'll tell you that that isn't an indicator of how wealthy they are. In fact, there's a whole lot of people who have their names on a lot of deals and they haven't invested much money, if any, especially not of their own. And so when you're buying this, please don't get caught up. When you're buying deals, don't get caught up in how many deals you have in your, or doors you have in your portfolio. What you're really looking for is, how is this increasing my net worth? How is this changing my income? And if those two things aren't driving your decisions, and you're more interested in the vanity metrics of being able to say you're a passive investor, or you wouldn't even say you're a passive investor, I've got a 10,000 doors, I think you're missing the point. The point here is to make an impact on the community and get income coming to you without you having to trade your time for money. Outside of that, I don't really know what the point of buying the assets are or would be. I've been playing with this comment a lot lately, and it goes something like this: nobody really wants the asset, nobody really wants the building. They want the income that it produces, or they want the impact to the residents who are living there. So just really keep that in mind, that this is not about how many doors you have or what your assets under management is. What's really important is how much income is it bringing to you and what type of net worth is it creating for you. And the net worth isn't something you can eat, but it's something you can leverage in order to get into more deals, which will send more cash flow. Myth number five. It's one of my favorite ones, man. You can't sell securities without a license. And so I am really, really sensitive when I hear people say, hey, I'm a capital raiser. And then if you go check FINRA, they don't have an investment license. They're not a dealer broker. They're not a registered investment advisor. And so if you're using that as a descriptor, you better be really careful about who you say that to and when you say it, because the Securities and Exchange Commission does not play around with people who are selling securities without actually having a license. And if you don't know the difference, then you need to really spend some time getting educated, because there are people who will tell you, hey, you can just raise money for my deal. And they're not telling you something that's in your best interest, because in their situation, in their case, they will not be the ones that have to deal with the ramifications of that if structured properly.
Jerome, I think I muted you by accident.
Back. There's a
Okay.
lot of people who would, he didn't want me to tell you guys this one. It's okay though, Jerry. All right. So there's a lot of people who would suggest that all you have to do is give the keys to the property manager and they're going to send you a check. I haven't met one yet that does that. And I haven't met an operator yet who feels that way. So when you get these deals, know that there is additional management outside of what happens when you close on the deal. It is not, here it is, here you go, I'm done, send me a check at the end of the month, or send me some checks at the end of the quarter. There, you are running a business. You are managing a manager who's running your business. You have to be, I think, active. You have to be visible, because they're typically working for other people, and the squeaky wheel gets the oil, unfortunately, with a lot of these things. Property management is a low margin business, and for a lot of people, it's a thankless opportunity. So when you are paying attention to the folks who are stewards over this huge asset that you've purchased, they'll treat your property better than a lot of the other ones may get treated, because there's only so much time that they have to go around. This one is probably my favorite, right? Every deal makes money every time. I don't care how good the operator is. There has been a situation where the deal didn't make money. They may have covered up by writing a check, but there's a situation where the deal hasn't made money, or they just haven't done enough deals yet. And as a investor, if you're an LP on a deal, or as a operator, you're going to get caught at some point. It's just the law of numbers. This is very much Vegas, right? The house is going to win, and it's up to you when you're buying deals to make sure there's enough cushion in your deal, so that if something goes wrong, you are in a solid place to ride the downturn, so that you can get to a exit when you get to the other side of the trough. Most people have no clue that there's a possibility that their deal won't make money. They hear about all the 8 prefs or the 6 pref and the 15% IRR, and they feel like it's a guaranteed bet. And because of compressed cap rates and a few other, and rents rising, people think that that's always going to be the case. But I can tell you that even though it's not well publicized, there are a lot of people who do deals, and the deal doesn't make any money. It doesn't appreciate because the business plan doesn't get operated. The rents don't go up because maybe the property manager isn't doing what needs to be done in order to market the property at a higher rate. I can go down the list of the issues, but know that this isn't a sure thing, right? And you can lose money, and you can just break even. So be really intentional when you're going through your due diligence to make sure that you understand what the deal truly has potential to do, and what are the risks associated with the deal, because most of us only focus on the upside when we put money in, and then when we get into the deal we realize that there could be some downside. All right, this one's my favorite, man. I keep getting, it gets better as I go on. I keep saying that the next one's my favorite. It's okay though. So the broker's going to bring me a deal that works. I have found that brokers don't bring deals that work. They bring deals that work for the seller. I was talking to somebody today, and they were talking about a deal not too far from me. And he said, yeah, the broker actually said that this guy has priced the deal about $25,000 per door higher than what we would expect it to be in this market, which really means that it's probably $50,000 over anything else that's traded in the market. And it was funny because it was a 1984 bill that got renovated in 2014, and the rents aren't commensurate with the asking price on the deal. And oh, by the way, we're going to have to renovate those units because they're 8 years old. And so there's going to be some opportunity to do some upgrades. And yeah, you can get enamored with the $200 or $400 below market rent and so on, but there's no guarantee that you're going to get that if you don't spend significant money in the capital piece or the uh, improvement of the property. All right, number nine. Number nine, we've got one more after this. And it's syndications are better than joint ventures. I think a lot of people, because of a lot of the content that has been created, the things shared on social media, the podcasts that are super popular, the seminars that suggest you can retire in a year or two if you're really careful or really lucky. I guess they don't say lucky. I think they say that, if you do this, you'll be retired in a year or two. That syndications are the way to go, right? The bigger, the better. You'll get a huge acquisition fee, et cetera, et cetera. And I just find that for most people, that's not real. You've got a very small amount of 100+ unit deals with syndication groups from all over the country chasing those same deals. They're all calling the broker saying the same thing about how they're associated with a group that does large investments, and they start talking about the track record of whoever the educator was that they paid the fee to. And then they think that they're getting an opportunity that most other people haven't passed on already. And it just ends up being pretty messy. I think there's other ways to get deals done. And the great thing about joint ventures is they're only limited by the capacity of the partners. If you have really well capitalized partners, there's nothing to say that you can't do, say, a $20 million deal if you have the right people in the game. And so be really, really, really thoughtful as you go through and pick how you want to structure your deal. It doesn't have to be 100 investors from across the country who you know based on very loose relationships. In fact, if it's your first deal, I would encourage you not to do that. I would encourage you to do a smaller deal, execute that deal. It'll be the hardest deal you ever do. Execute that deal well. And then once you execute that deal, use that as part of your track record to attract other people to come to the deal. It'll do a few things for you. One, it'll allow you to test out your partners, right? So your property manager, the other partners who are helping you operate the deal, and see if you guys have a great working relationship. The last thing you want to do is bring 50 people to do a deal and then find out that your GP isn't going to work out, or your property manager isn't going to perform, or your construction partner isn't as good as you thought they were based on their website. You really want to have real clarity and a working knowledge of how people are going to interact with each other before you go out and risk your reputation with very little recourse if things go wrong, right? There's not really a way that you can navigate that, especially if you do deals that are so big that you can't write a check to fix the problem that's happening there. And the bigger the deal, the harder it is for you to actually get things back on track, because they take more time, and the capital that it takes to actually fix them is pretty difficult, or pretty substantial. And so the last myth is my favorite one. I got to blow this one up for you. It's absolutely my favorite one. I said about 5 of them were my favorite. This one is absolutely my favorite one. So there's a lot of people out there that will lead you to believe that if you go through a high ticket coaching program or education and mentorship program, that you're going to lead a huge deal. Emphasis on lead. What I see happen with a lot of people is they just become a capital raiser for somebody else's deal in the community. And then they get their name on the asset, and they never actually find a deal that is their deal. And now they're just kind of pigeonholed to this. Oh, can you bring your investors to this deal? Can you bring your investors to that deal? Instead of actually being that operator that they set out to be when they got into the space and made the investment. So myth number 10 is the one that I think trips up more people than not. And so that is the 10 myths that I think trip up the vast majority of multifamily investors. And I would love to debate on these, or you guys can tell me that I'm absolutely right and I can go to bed early tonight. Either one works well for me.
I, hey, Jerome, so Miguel here.
Hey,
First of all, thank you so much. I mean, I think every time I hear you talk, there's always some great gems that are dropped there. I love your backstory. I compare, or I model a lot of what I look to accomplish based on your success story. So thank you for that, sharing this with everyone in our communities. Um, Question for you. I mean, because you on a few slides you talked about the myth of, and you started with saying that the cap rates are kind of compressing, and I just kind of correlate that with there being less and less opportunities with the Fed rising, right? Interest rates kind of going up. You stated that someone's going to be left in an empty chair in terms of repositioning these assets and kind of lending here, coming out there. What have you been telling your investors or how have you been kind of strategizing to kind of downsize the risk for investors, just to prepare for that chair being full when it's time to exit?
Yeah, so we're doing one or two things. We're either selling, or if we refi, we're going to refi into something that's north of a 10-year period. Right? Our goal is to make sure that interest rates aren't the reason why we aren't successful. And not successful means your debt service coverage ratio is too high, so you can't actually get the deal refinanced. We want to kick that can as far down the road as possible, or we want to get out of the deal because long term it doesn't fit into what we see our portfolio being or becoming.
That's awesome. See, not really a debate question, but a great topic for you to cover. Thank you. I'm
Thank
sure
you, Joe.
somebody's going to debate one of those. I wanted to bring
I'm
back.
desperate for it.
Hey,
I'm
hey
desperate.
Jerome. Hey
Hey,
Jerome, I'm very disappointed. I actually agree with all of these things, but I wanted to highlight the pyramid that you had there in the beginning. So for
yeah.
people on here, definitely, and I'm sure you've heard Mark's a nice story on when we first got started on the Philadelphia deal. Knowledge, definitely first thing on that pyramid, the largest and most important, followed by deal flow and experience. I think those two maybe can be interchangeable a little bit, the experience and the deal flow, perhaps working together side by side, and then capital definitely at the top. And then capital raiser, you mentioned that. I just want, for Myth 5, I just wanted to caveat that. I mean, you can be a capital raiser for a syndication. You just need to be part of the GP team, you need to have a role, some sort of role and some sort of active involvement in the deal, correct?
You can't just be a capital raiser.
You
That's
cannot be correct.
and that's where people go. It's like, oh, well, I'll just be a capital raiser. And then usually what happens is the smart operators will say, well, you need to raise at least this, and then we'll put you in the GP. But the people who you bring to the deal, if you don't hit your minimum, they're still going in the deal, right? So all you did was bring capital to a deal. I don't work for the SEC, but I think maybe you should talk to a securities attorney when you're doing that.
Yeah, I wanted to dig in a little bit about JVs because we're, definitely after many years of kind of looking at the syndication and really thinking, yeah, this is the best, this is the way to financial freedom. We've gotten kind of smarter and followed your path a little bit, right, with joint ventures. How do you structure your joint venture deals when you kind of go together with another partner or two partners on a deal?
Yeah, so the person who found the deal gets to keep some of it, right? And I just call that sweat equity. Marketing, combing through and doing phone calls or mail or whatever you do to source deals is pretty important. And so whoever can negotiate that, get the numbers and the model in a situation that works for the people who are investing in the deal deserves to be rewarded for that. And then the rest of the ownership is based on signing the loan and then however much money you put in for the rest of it. And so we feel like the people who put more money in the deal should have more of a say in what happens when you've got operational decisions that need to take place. And, we work really hard to make sure that because I'm usually the asset manager on the deal, we put as much or the majority of the money in. There are times where we don't, but for the vast majority of them, we put the most money in, and then we do everything we can to make sure that nobody really has to spend money if something goes wrong at the property and we come up short.
Thank you.
This is too easy, man. Come on.
There's got to be some tough questions out there. Come on.
So I'll argue with my man because he said, hey, you can switch 2 and 3 just for the sake of argument. So it doesn't matter if I have an experienced partner if I don't have a deal. It doesn't matter. What matters is you got to have the deal for the experienced partner so you can get the money. If you have a bunch of people who have experience sitting around, it's nice, but you guys aren't going to be able to get anything done. And so you can have experienced people in your network, but until the deal happens, it's not going to actually work. And they don't know if they actually want to do the deal with you until you have the deal.
So does it become a little chicken and egg? Because if you don't have experience, you're trying to get that deal, who's going to talk to you?
Well, so here's what I learned the hard way. No, here's what I learned being on the other side of the table. There are a ton of people who send me stuff that's on MLS and say, hey, will you look at my deal? I won't. I don't care. It's not your deal. Like, a broker sent that to 83 people. And I'm not going to win best and final out of the top 20. So, but if you went to an owner and you got that thing under contract and nobody else has seen it, and the owner doesn't realize that things are trading for $100,000 a door, and they let you contract it for 65 because they paid 22 for it, now we got something to talk about. If you have the experienced people and then you go find the deal, I don't think you're actually in control of the actual project. And so that for me is the true value proposition for people who are trying to get into the space. I still remember standing in a flip that I was doing. It was a $90,000 budget. And the guy asked me, what was I going to bring to the table? And while I had an engineering license and a contractor's license and all this stuff, I didn't say any of that. I told him, I don't know, we'll figure it out. But if I was the person who had written that contract and gotten the deal in a situation and I went and brought that to him, then I would have been on the other side of the table asking, hey, what are you going to bring to the table?
Yeah.
Having the deal first puts you in position to actually control your destiny. If you are in this mix of experienced people and you don't have the deal, it's very likely that you'll be left sitting on the sidelines if you don't have experience.
So anyone else out there want to jump in?
I think what you just said, Jerome, is especially true right now with how heated the market is. I mean, I think when I started a couple of years ago, it was a little bit easier to get into a deal than it is now. And now that, every single person seems like they're selling their property, every single one seems to be getting listed with the big guys, Marcus and Millichap, Capstone, all of them. And every single time I talk to a broker, they're like, yeah, we got 15 calls on this just in the past 4 hours or something like that. It just makes more and more sense that controlling the deal means controlling, or finding the deal gives you that much more control.
Yeah, not only did they get 20 calls on it or 15 calls on it, but they're all over asking. And, when you do your analysis and you see that it's only worth 80% of whatever it's listed for, they laugh at you when you send over your LOI. And I struggle with the concept of somebody being able to buy something at a reasonable cost basis that's been mass marketed right now.
And I also, this is more related to your last slide that you had put up, kind of about, I think it was basically going to the big guys, partnering with the big guys.
Yeah.
And, I agree with what you say there, that you're not going to get a lead position. I also agree that, or I guess my opinion is, so I kind of started working with my dad and we decided we weren't making much progress and we're going to go to a 3-day weekend, boot camp thing. And we ended up buying coaching for, 6-8 months, whatever it was. We did what we thought we were supposed to do, but I think we had this preconceived notion that if we go through this, we're gonna get the deal. And it turned out we did not partner with that person. We didn't find a deal for, maybe it was another year after we stopped the coaching, all that. But what it did do for us, at least, was give us that mental drive to continue at it, because it was, you know, it was a struggle trying to call brokers every single day and underwrite deals every single night and go through everything. So I do agree with your slide, but I do at the same time, I feel like there is a little, at least for me, there was something to it where I was like, I put up this money. I'm going to make sure I get something out of this. And this is what I want to do. So there was a little mental drive to it.
Yeah, without question, there's magic in the transaction, right? When somebody actually puts their hard-earned money on the table and says, "I'm committed to this outcome," so much so that I'm willing to spend money on it, there is a switch that happens. And depending on how high the five-figure investment is, determines what they're willing to do in order to get the thing actually done. Because the thought of putting that money out and then not getting a return on it is more painful than the comfort of just being able to say, "Oh yeah, we tried, it didn't work." Now, but most people are under the impression when they make that investment, hey, if I know one lady who spent 100 grand on coaching through a bunch of different programs. She was under the impression that when she got her first acquisition fee, that it would wash all of that away and that she would be in a position where, you know, she was financially free. For her, that's not what happened, right? Eventually, and it didn't happen in the year or the 8 months or the 16 or 18 months. It took her much longer than that. Eventually, she got some deals done and she was rewarded for her investment. But I don't know that she would have kept going had she not risked everything, because the level of belief and commitment she had to have in order to take that money out and offer it to somebody to help show her the ways of multifamily investing was really, really high. And I used to be really critical of when people ask for those types of dollars, because I was like, it doesn't cost that much to teach somebody the ways of doing it. And so we designed a program for that. But, and it's a big but, when people make that level of investment, it does a few things. One, it weeds out the people who aren't financially able to do it. The other thing that it does is it shows how committed they are to actually executing against it. And there is no way around that. You can say, "Oh, I want to do this, but I'm not willing to spend $1,000 a month to get it, or $20,000 or 50, depending on what program you go to," and that's fine. But the people who spend more money up front tend to get the result faster because they've put that money on the street and they've shown how serious or committed they are to the outcome. And I didn't understand that coming in. Now, I didn't go through a program either. So, you know, I sit on the other side of that. But what I will say is my portfolio would probably be 3 to 5 times bigger than it is today had I actually been wise enough to go through that, because it would have compressed the time that it took me to figure out the stuff that I figured out. I did it the wrong way. I did it the free way. I listened to podcasts. I watched YouTube videos. And then when I actually got a deal, I fumbled all over the place because I had no idea that I didn't know what I was doing. Like, if I'm just straight up, I had no idea what I was doing. And that's not the way to learn how to do this, especially when other people's money's at stake.
You could argue that instead of paying, especially if it's a higher dollar seminar or training, that person could find somebody with experience and do the networking that's necessary and do a joint venture on whether it's a 5 unit or a 25 or a 50 unit, and really learn through experience. And that would probably be a better use of money. I mean, maybe it depends on the person or the people you're partnering with, though.
Yeah, so I guess there's two things. I agree wholeheartedly. And so the solution we designed is an 11-week course. It's $5,000. People go through the modules. We introduce them to the community, and then they take the other, depending on who they're looking at. It can be anywhere from $15,000 to $45,000, and use that in their deal, right? But they have the education that they needed to actually know what it takes to operate a deal in the end. And they can actually have conversations from a place of education instead of what they heard on the latest podcast episode where the operator was on their beat in their chest. And so I think that model makes sense. And when you pile on the thought that we want people to do joint ventures so that the damage that is a part of your reputation is smaller because there's more condensed group and typically they know you well. It's not like you had a 15-minute call with an investor and you told them about the person who's got 11 units and now you're going to bring their money to their deal because their experience and so on and so forth. I think it's a much easier sell that, hey, me, Ryan, Jerry, Gonzalo are doing the deal. We all know each other. And then boom, we can jump in and get something done.
Awesome. So it's 8:30. I want to be respectful of your time.
Wait, Jerry speaking at a conference. He thought he was going to get out of here, man.
Oh man, that's awesome.
Jerry's speaking at a conference, y'all. So we got the Mid-Atlantic Multifamily Investing Conference happening this weekend, February 18th through the 20th. Jerry is moderating an amazing panel about long distance investing. Susie is on here. She's going to be there too. And this isn't a seminar. This is an opportunity for you to network with people from across the country. I did a poor job naming it because I said it's Mid-Atlantic, but it's for people across the country. And actually, Billy's coming in from Spain. So with that said, it's an international conference at this point. So I don't know if you guys are busy. It's President's Day weekend, but come support Jerry if nothing else.
Fantastic. That's awesome. I'm going to drop it in the chat, your LinkedIn as well as your website. Is this the best way to reach you?
For the conference, let's drop this one. It's going to be absolutely epic. This is not your traditional multifamily investing conference. I can promise you that. We got the most diverse lineup of speakers in the country, and it's intentional. Part of my mission is to show people from all races and creeds and sexes that they can do this business because I believe that they can. And I just don't think that the narrative of mainstream or more popular events actually shows the folks who are actually doing the business. So we're out here.
And with a good looking lineup like that, you just got to go.
Got to get Jerry in the room, man.
Yeah. Well, Jerome, I appreciate it. This was awesome, man. This is great. I think you gave us a lot to think about. I'm sure everyone, once they get off this call, will definitely do some soul searching and thinking. This was great, and appreciate you coming on. For the rest, we're going to do some networking. Hang on. But Jerome, I'll let you say final goodbye before you go.
Yeah, I'm just grateful for the opportunity to share. Hopefully somebody picked up something or got a friendly reminder on things that they already knew but maybe forgot about. I just want people to actually get in this business, buy great deals, make money for them and their partners so that it's not so hard for people who are trying to do deals to actually do deals. You know, the more great experiences people can have doing this business, I think the better off it is for every operator who's out here trying to do the right thing.